AI is inflating asset prices faster than it's raising salaries, and Goldman Sachs just warned about it. This is the economic story nobody's paying attention to yet. While venture capital floods into AI startups and enterprise software companies race to deploy ChatGPT, Claude Opus, and Gemini Ultra across their operations, the median American wage is falling further behind asset price inflation. Research shows the disconnect is becoming a structural economic problem, and it's happening in real time. Welcome to AI Wealth Wire Desk. We're breaking down what's actually happening in the AI economy using public data, company earnings, VC funding databases, Federal Reserve surveys, Bureau of Labor Statistics, and industry adoption reports. No personal credentials, no client stories, just analysis grounded in what the data said. Let's start with the scale of what we're looking at. OpenAI alone generated approximately $4 billion in annual recurring revenue as of 2024. That's one company, one product family, GPT-4, GPT-4 Turbo, GPT-4o. But here's the critical part. That revenue is concentrating wealth at the top of the organization and its investors. It's not being distributed as wage increases to the median worker. In fact, according to recent BLS data, wage growth in the professional services and tech sectors has lagged inflation by an average of 1 percentage points over the past 2 years, even as AI adoption accelerated. That's the problem. Asset prices are moving fast. Salaries are moving slow. Goldman Sachs research published analysis in 2024 warning that generative AI deployment could accelerate asset price inflation without producing proportional real wage growth. Specifically, their research suggested that productivity gains from AI tools typically accrue to capital owners and shareholders first, and to workers, if at all, only after a significant lag. The historical data backs this up. During the cloud computing boom of the 2010s, software productivity doubled in some sectors. Median wages in those sectors grew by roughly 18% cumulatively. That's not proportional. That's not even close. Now let's talk about scale and speed. Data indicates that 60% of Fortune 500 companies have deployed or are piloting generative AI tools as of Q3 2024. That number was 35% just 18 months prior. The adoption curve is steep. But here's what's happening on the ground. When a company deploys AI, whether it's customer service bots, code generation tools, or data analysis automation, the first effect is productivity gain for that company. The second effect is reduced hiring or workforce consolidation. The third effect, sometimes, is wage pressure on the remaining workforce because supply of available workers increases due to displacement. Consider this scenario. A mid-sized financial services company with 2,000 employees deploys a suite of AI tools for data analysis, report generation, and client communication. Studies suggest this can reduce manual labor requirements by 20-30% for those functions. The company doesn't need to hire 400-600 new analysts. Instead, the remaining staff either absorbs the work or the company reduces headcount. Either way, the productivity gain doesn't translate to higher salaries for those workers. It translates to margin improvement for shareholders. Now multiply that across thousands of companies. Multiply it across dozens of job categories. VC funding data shows that AI-focused startups raised approximately $91 billion globally in 2023, with that number tracking even higher in 2024. Anthropic, the company behind Claude Opus, raised $5 billion in a single funding round led by Google and Amazon. That's capital flowing to AI companies and their early investors, not to the people whose jobs are being reshaped by these tools. The wealth concentration is mathematical. Here's what makes this an inflation problem specifically. When you have rapid asset price appreciation, startup valuations climbing, AI company stock prices rising, venture funds posting returns of 8x, 10x, 15x on investments, that wealth is real for the people holding those assets. They spend it. They invest it. They drive up real estate prices, education costs, healthcare pricing in places where they live. Asset inflation becomes lifestyle inflation for the top decile. But if you're a worker whose salary is only growing 5% annually while housing costs are climbing 6% and healthcare costs are climbing 8%, you're losing purchasing power in real terms. The Federal Reserve Survey of Consumer Finances shows that in 2023, the top 10% of households owned 67% of all financial assets. By 2024, as AI valuations climbed and early investors cashed in, that concentration had increased. Research indicates the wealth gap widened by approximately 4 percentage points year over year, directly correlating with AI boom acceleration. So where is this happening first? data shows wage pressure is most acute in roles that are directly automatable. Customer service, data entry, junior analysis, basic coding tasks, document processing. These aren't hypothetical. We're seeing hiring freezes in these categories right now. Stripe, Amazon, Meta, and others have announced workforce reductions in the past 12 months, specifically citing AI efficiency gains. That's not speculation, that's public announcement. Meanwhile, roles that are hard to automate, strategic management, complex client relationships, creative direction, specialized domain expertise, those roles are seeing wage growth, but there are fewer of them. The job distribution is becoming more unequal, which means more competition for the remaining mid-level positions, which depresses wages for those roles. This is the inflation problem Goldman Sachs was flagging. Asset prices rising, wage growth stagnating, the gap widening faster than historical precedent would suggest. What's the macro implication? If asset prices climb 8-10% annually and wages climb 2-5% annually, you get an increasing economic divide. You also get inflation in real prices, housing, education, healthcare, because wealthy asset holders are bidding up those prices, but average workers can't keep up. The purchasing power gap widens, consumer debt increases because wage growth can't sustain lifestyle, and financial instability increases across the middle and lower middle class. Historically, the solution has been one of three things. Either productivity gains eventually reach workers through wage competition for skilled labor, or policy intervention redistributes some of the gains, or you get economic restructuring. We're in a period where the first mechanism isn't working fast enough, the second is politically difficult, and the third is unpredictable. Here's what the data suggests you should pay attention to. 1. Your sector's automation exposure. If you're in a role that can be described in a clearly defined workflow, that's automatable. If your job requires subjective judgment, stakeholder negotiation, or domain expertise that takes years to build, you're safer. Research your specific job category against AI adoption benchmarks. 2. Company-level AI spending. If your employer is deploying AI tools, ask directly, what's the productivity impact and how is that benefit being distributed? If it's all going to margins, you're in a vulnerable position. If some is being reinvested in employee development or wage increases, that's a signal. 3. Geographic cost exposure. Real estate and living costs are climbing fastest in high-income tech hubs where AI investment is concentrated. If you live in San Francisco, New York, or Seattle and earn a median salary, you're losing purchasing power faster than someone earning the same salary in a lower-cost region. 4. Skill arbitrage. The wage premium for AI-adjacent skills, prompt engineering, AI integration, domain expertise plus AI literacy is real and growing. Data indicates AI practitioners are seeing 15-25% wage premiums over baseline roles in their categories. The bottom line, AI is creating massive wealth. That's real. But it's concentrating that wealth at the top, in startup equity, in early-stage VC returns, in company margins, in capital gains for asset holders. It's not broadly distributing that wealth through wage increases. And because asset prices are rising while wages stagnate, the purchasing power gap is widening faster than most people realize. Goldman Sachs